The U.S. economy is red hot, but not in a good way. Consumer prices in the world's largest economy rose 8.5% in March. Last month's reading was slightly higher than expected and represents the biggest blow to household budget in 40 years. That increases pressure on the Federal Reserve to continue raising borrowing costs, a move that could choke economic output. Rising inflation is tied to the cost of oil, which has gone up due to Western-led sanctions on the crude exporter Russia. To ease that burden on consumers, the White House is easing regulations on ethanol. It's a type of fuel that's made with locally grown crops like corn and sugarcane, and its use aims to trim demand for imports.
The Environmental Protection Agency is planning to issue an emergency waiver to allow E15 gasoline that uses more ethanol from homegrown crops to be sold across the United States this summer in order to increase fuel supply.
Now for more on the story, let's bring in Han Tan. He's the chief market analyst at the Exinity Group in Abu Dhabi. Welcome back to the program, Han. Now, first, can you just walk us through what the market reaction has been to this data out of the U.S.?
Right. So let's look at U.S. assets. The U.S. dollar weakened initially, and the S&P 500 climbed, only for those moves to be reversed. So the initial take was that U.S. inflation may be close to its peak, judging by the core CPI print. But the inflation data was then followed up by more hawkish comments out of Fed officials. So it forced markets to reconcile with the prospects of higher U.S. interest rates coming in at a faster clip, hence the climbing dollar and U.S. stocks ending lower.
Now, to the point of trying to bring down inflation, the U.S. is obviously desperately trying to increase the supply of oil in the market. It's already releasing millions of barrels of crude from its reserves, and now it's easing rules on the use of ethanol for the summer. What kind of effect do you think that's going to have?
Yeah, in short, I expect a temporary effect, right? Granted, yes, we have seen oil prices being dampened since those announcements, and it may continue to have that dampening effect over the coming months. However, markets are aware that these reserves will have to be replenished eventually, so these relatively lower oil prices may only be here for a while. I think a lot of the focus still remains on the potential for EU sanctions on Russian oil, because if that happens, that's a much larger hole to fill. Markets are aware of this, hence the oil prices are still relatively elevated.
So what are the options now for policymakers, both on the fiscal side, the government, and, as you mentioned earlier, the Federal Reserve?
Yeah, great point. So I think the Biden administration is still beholden to that moral imperative to send a stronger message to Russia, right? So that could actually translate into some economic pain for the U.S. Over at the Fed, I think these persistently elevated inflation readings have essentially paved the way for a larger than usual 50 basis point hike next month, and potentially a similar move in June as well. But I think markets are already looking past that and really starting to contemplate how much the Fed can actually hike, and it really depends on how well the U.S. economy can withstand those higher interest rates.
All right, Han Tan from the Exinity Group in Abu Dhabi, thank you for joining us as always.